right, let's dive into something that might just change the way you look at financial markets forever. We're going to talk about trading. But forget all the complicated indicators and the weird, mystical patterns for a second. Today, we're pulling back the curtain to see what really makes prices move.
And it all starts, believe it or not, with a story from over 2,000 years ago. It's Plato's allegory of the cave. You might have heard of it. Basically, you have these prisoners chained up, facing a wall. All they can see are shadows, and to them, those shadows are reality. It's actually the perfect metaphor for how most people see the markets.
So let's start there. Let's talk about how the vast majority of traders operate, which is essentially by staring at those shadows on the wall.
Now, if you've ever tried trading, this is going to sound super familiar, right? You're taught to hunt for head and shoulders patterns, or wait for moving averages to cross, or look at what the RSI is doing. You're glued to the charts, trying to make sense of all the wiggles and lines, thinking that this is the whole game, that those patterns are the market. But what if they're not?
This is the key distinction. On one side of the ledger, you've got the illusion, or what we'll call the effect. That's the price movement, the technical patterns, all the stuff most traders are obsessed with. But the other side, that's the reality, the cause. And that's the big mystery, isn't it? What is actually causing those shadows to dance around on the screen?
Okay, so it's time to do what the philosopher in Plato's story did. It's time to turn away from the wall, break the chains, and look straight at the fire, the true reality of what's going on in the markets.
And here it is, the big idea. Price movement isn't the thing, it's the result of the thing. You know, it's like finding a footprint in the sand. If you only study the footprint, you're never going to understand the animal that made it. To get a real edge, you have to stop chasing the effects and start digging into the cause.
This right here is the answer. The market isn't some abstract thing driven by news headlines or super smart algorithms. No, at its very core, the market is just a huge collection of human beings making decisions. Decisions based on their own beliefs, their greed, their fear, their hopes. It's a human system, through and through.
So, if it's all just about people making decisions, how does that turn into the charts we see on our screens? Let's break down the mechanics of how prices actually move.
Think about it like a simple housing auction. Picture it. There's one house for sale, that's your fixed supply, but you've got, say, a dozen potential buyers. That's your demand. What happens? They start bidding against each other. The price goes up and up and up. And who wins? Who gets the house? It's the person who is the most urgent, the most desperate, maybe the most emotional about needing that house. Their urgency is what drives the price.
And that brings us to the classic idea of supply and demand. All it means is this. When there are more aggressive buyers and sellers at a certain price, the price has to go up to find someone willing to sell. And when sellers are more desperate than buyers, the price has to drop to find someone willing to buy. Price moves because of an imbalance in that urgency. Simple as that.
Now, financial markets are a bit more chaotic than that housing auction. They're what's known as a dual auction. It's not just buyers competing against other buyers. You have buyers trying to get the lowest price possible from sellers, while at the exact same time, sellers are trying to get the highest price possible from buyers. It's a two-sided battle.
And this is what that dual auction looks like when you peek under the hood. It's called a depth of market, or a DOM. On the left, you've got all the buy orders at different prices. Those are the bids. On the right, all the sell orders, the asks. Price only moves when one side gets aggressive and crosses the gap to take the price the other side is offering. This is the market's engine room.
So let's just break it down. When demand is stronger than supply, meaning the buyers are more urgent, they start hitting those sell orders and the price ticks up. The other way around, when supply is overwhelming demand, sellers get desperate. They start hitting the buy orders and the price ticks down. And the key thing to remember is that this imbalance isn't some random force of nature. It's the direct result of the collective human emotion of every single person in the market at that moment.
Okay, so we've established that the market is just a giant crowd of people. So what? How do we actually use that? Well, the next step is to stop seeing charts as abstract art and start seeing them as a story about that crowd's behavior. So your goal completely changes. It's no longer about trying to predict what some pattern is supposed to do next. Instead, your job is to read the shifting sentiment of the crowd. Are the buyers feeling confident and getting stronger? Or are the sellers getting nervous and losing control? The chart is a direct window into that human drama.
So check this out. A traditional chart watcher might see this and start drawing all sorts of complicated lines. But let's just read the story here. Look at those pushes down. A, then B, then C, then D.
See how each attempt by the sellers to push the price lower gets weaker and weaker. The momentum is just dying. That's not a pattern. That's the story of sellers running out of gas and buyers starting to take over.
And that means that the speed of the market, its momentum, becomes one of your biggest clues. You start asking totally different questions. Is the price moving with force and acceleration? That's confidence. Or is it slowing down, looking sluggish? That's hesitation. These aren't just squiggles on a chart. They're the vital signs of the crowd's fear and confidence.
Okay, so putting this all together leads us to a completely new way to even think about the game of trading, a new paradigm.
The real game is not you against the market. It's you analyzing the decisions and likely actions of all the other traders. Your job becomes figuring out what they're thinking, where they feel safe, and most importantly, where they are starting to feel the pressure. Where are they feeling the pain?
And here's the kicker. This is the secret sauce. Normally, people can be really unpredictable. But what happens when they're under stress, like when they're about to lose a lot of money? Well, their reactions become simple, primal, and incredibly predictable. They panic. They give up. They all tend to do the exact same thing at the exact same time.
And that is the ultimate advantage. Instead of just being another sheep in the herd, getting scared and getting greedy with everyone else, you can become an observer. You learn to spot those moments, those price levels, where their herd is about to get squeezed, where their fear is going to force them to act in a predictable way. And you can position yourself to take advantage of that reaction.
So let's end with this thought. The next time you pull up a chart, try to stop asking, what's this pattern? Or where's the price going to go? Ask a much better, much more powerful question. Looking at this, where's the crowd stuck? Where are the other traders trapped and about to feel the pain? Because answering that question, that's the key to trading reality, not just the shadows.